Hello and welcome. You're watching Market Cafe with me, Ankita Saxena, and with me is my co-anchor Snehi Shah. Snehi, today is Friday, last day of the week. Tell us how the global markets are looking like. A mixed handover coming in there, even though Dow clocked in a ninth straight day of gains.
That's right, Ankita. Mixed session coming in from the US markets. Good morning to all our viewers. Let's quickly look at what happened in the US markets yesterday. And the moves in extended trading followed a mixed session on Wall Street. Now, the S&P 500 lost about 0.7%, and the Nasdaq Composite was the one that took a major beating and was down 2%. The Dow was the outlier of the three, adding nearly 164 points or about 0.5% of gains for a 9-day rally, which is its longest since 2017 and its highest close since March 2022. Now, the 30 stock Dow was boosted during Thursday's regular trading by a strong report coming in from Johnson & Johnson. But on the other hand, you had slides in Netflix and Tesla shares a day after the companies posted their results, and this is what weighed on the other two indices in the session. The transportation stocks CSX and Knight-Swift fell 4% and 3% respectively in extended trading after reporting earnings that underwhelmed Wall Street analysts. Those are the latest reports in what's been a generally strong earnings season thus far, with 73% of the S&P 500 companies that have already reported earnings exceeding analyst expectations, according to FactSet data that's coming in. On a weekly basis now, the Dow is up more than 2% and on a pace for its second positive week in a row. The three major indices have diverged in performance this week, with just Friday's session left in the trading week. Here's where each of these index stands. The Dow is up 2.1% on a weekly basis so far. S&P 500 up 0.7%. It's the Nasdaq Composite, on the other hand, that is down 0.4%. Now, if these performances hold, it will be the second straight positive week for both Dow as well as S&P 500. Let's quickly shift focus to Europe then, and European markets closed higher on Thursday as investors assess the implications of some big US corporate results and the start of the earnings seasons back at home. Now, the Pan-European Stock 600 closed 0.4% higher, with tech stocks ending the sessions 2.5% lower on the back of weak US earnings, while mining stocks added 1.5%. The European Blue Chip Index closed the previous session up 0.3%, with Britain's FTSE jumping 1.8% as the British pound and UK bond yields fell sharply on the back of cooler than expected inflation data. So largely mixed handover coming in from the US, a slightly positive one coming in from Europe. But this is what the global handover looks like on the equities front. Ankita, take us through what crude and other commodities did.
Right, Snehi. So crude is little changed today morning if you look at the crude prices, and they're set to close absolutely flat for the week after 3 straight weeks of gains as markets weigh lower US crude inventories and tapering interest rate hikes against the weak Chinese economic data that could actually cap demand. Brent is on track to close down 0.2% for the week, while the WTI is set to tick up 0.4% for the week. Both benchmark had gained for 3 consecutive weeks. Now, supporting prices, US crude inventories fell last week, supported by a jump in crude exports as well as higher refinery utilization. Brent crude is currently at $79.84 a barrel, whereas WTI stands at $75.63 a barrel. So that's where the crude is trading at, Snehi.
All right, thanks Ankita for all those details. Then let's move on and talk about all the important cues that you should be keeping on your radar today for this Friday's trading session. On the earnings front, then on the Nifty 50 front, you've got big boy Reliance reporting its Q1 numbers. Keep an eye out on that. Followed by that, you also have HDFC Standard Life, Ultratech Cement and JSW Steel on the Nifty front that will be declaring their Q1 numbers today. On the non-Nifty front from the broader markets, you've got Hindustan Zinc, Credit Access Grameen, Ashok Leyland, 197 Communications, which is Paytm, DLF and Vedanta. All of these will also be declaring their Q1 numbers today. On the corporate action front, then you've got the board of Federal Bank that will be mulling fundraising today. The board of Aarti Drugs will be mulling a share buyback today, and the board of GNA Axles will mull a bonus issue today. And on the other events, you've got 2 big releases hitting the box offices this week. Rather today, it's Barbie as well as Oppenheimer. All eyes will be on the box office as you've got a lot of buzz and frenzies surrounding these 2 movies, Ankita.
That's right, Snehi. I mean, look at the marketing campaign that Barbie has gone on. It's
Absolutely.
almost like the pink paint in the world has got over because of the marketing that Barbie has done. So let's
Absolutely.
look at how it fares at the box office. Does it really live up
Absolutely.
to the hype that it has generated?
Lots of pre-sales bookings also coming in for both Barbie as well as Oppenheimer, and Barbie has already sold 70,000 tickets only for the opening day, so that's like a massive number coming in. Also for Oppenheimer, also you've got Oppenheimer sold 2 lakh tickets for the opening day itself, for the opening weekend. Big numbers coming in. Let's see, reviews have come in strong. Both have fared well on Rotten Tomatoes as well. Let's see how these movies pan out for the box office and also for multiplex stocks that we have on Dalal Street.
That's right. I hope it gives a big fillip to all the multiplex stocks.
Absolutely.
Big releases there. But let's move on and find out what made news overnight in the global markets. Japan's consumer price rises to 3.3% in June, with the pace of inflation accelerating from 3.2% in May. Japan's government expects inflation to sharply exceed Bank of Japan's target. Meanwhile, Turkey's central bank has hiked its key interest rate by 250 basis points to 17.5%, much below the analyst expectations of 500 basis points, as the country's policymakers embark on a long and painful mission to tackle double-digit inflation.
And online video streaming giant YouTube has gone ahead and hiked prices for its monthly and premium plans in the US for the first time since the subscription service was launched in 2018. Now, the premium plan will now cost $13.99, up $2 from earlier. The price for its annual plan is hiked by $20 to $139.99.
And as the electronic demand slump continues, Taiwanese chipmaker TSMC reports first profit drop in 4 years in their Q2 earnings, a 23% slide in profits. Meanwhile, one of the largest cigarette company, Philip Morris International, beats analysts' expectations for quarterly profit and raised the lower end of its annual earnings forecast as tobacco and labor costs are easing.
And billionaire Elon Musk's fortune takes a hit after the share price of his electric vehicle titan Tesla succumbed to its biggest slide in the last 3 months. Musk's net worth slipped from $256.8 billion to $238.4 billion, staggering losses that followed a 10% correction in the Tesla stock.
And on to some country-specific updates. France President Emmanuel Macron undertook a government reshuffle in an attempt to move past the series of crises plaguing his term since re-election. As per reports, the reshuffle, though limited in scope, is aimed at a fresh start with some notable changes in the key ministries.
Alright, with that, let's slip into a very short break today then, and we'll come right back with what the Asian markets are doing on the other side.
Welcome back. You're watching Market Cafe with me, Ankita, and with me is Snehi Shah. Now, before we take you on to the news on the domestic front, let's quickly take a account of what the Asian markets are up to and how they have opened up. So Asian markets are largely in the red. Now, that is primarily on the back of the fact that inflation data that has come out of the Japanese market. Now, Japanese consumer price index figures for June are out, and the country's core inflation rate, which strips out cost of fresh food, came in at 3.3%, in line with expectations of economists polled by Reuters. Now, this is slightly higher than the May's figure of 3.2% and also above Bank of Japan's target of 2%. Now, the country's headline inflation rate also came in at 3.3% in the month of June, up from May's figure of 3.2%. Now, remember, we also have Bank of Japan's meeting next week for its rate decision, and on the back of that, we can see Nikkei, that's down 97.3% in the red. Let's go across to the other markets, how they have opened up. We also have Shanghai. Let's look at Shanghai. Shanghai is down very flat. It's in the red, opened 7 points lower. We have Hang Seng, which is again absolutely flat, has opened the day in the green, but absolutely flat. Kospi again in the red, very flat, just down 7 points. So largely the markets are in the red. ASX 200 down 23 points. Look at Gift Nifty, also very flat, just up 12 points, hinting towards a rather muted and a tempered start for Indian markets as well, Snehi.
Absolutely. GIFT Nifty coming in absolutely flat. Let's see if we are able to cross that 20,000 mark on Nifty today. But with that, let's quickly slip into a short break. Hi there, welcome back and thanks for staying tuned to Market Cafe with me Snehi Shah and Ankita Saxena. Now yesterday we had IT major Infosys that declared its Q1 numbers and we had a rather disappointing set of numbers coming in. Now Infosys has forecasted a bleak year ahead and the tech major has sharply lowered its FY24 revenue guidance to 1 to 3.5% from its previous outlook of 4 to 7%. Now the Salil Parekh-led company has attributed this sharp downturn to clients cutting back on spending. Moreover, profit for the quarter has also come in lower than analyst expectations. Infosys ADR has taken a hit, tanking about 12% at open. Anisha Jain joins in for all the number crunching. Anisha?
Well, the Q1 performance from Infosys was fine, but the big headline is that they have cut their guidance and cut it very sharply. At the start of the year, they had talked about a growth of 4 to 7% in FY24, and that itself wasn't liked by the street. Now they have cut it further to 1 to 3.5% for full FY24, though they have managed to maintain the guidance of 20 to 22% when it comes to the margins. This big disappointment is coming despite the fact that the Q1 performance has been all right. In fact, in the quarter gone by, the company reported a constant currency growth of 1%, bang in line with our expectation and towards the higher end of the expectation range of the analysts as well. Even if you look at the margin performance of Q1, it came in at 20.8% versus our expectation of 20.9%. So not a big miss there, but that guidance cut itself has the street worried whether the company is talking about some large cancellations. Are they looking at something specific that will fall into place in Q2 and H2 and that will put a pressure on the execution? So all of these details is watched out for. But if you look at the other internals, the dollar revenue came in at 4,617 crores, better than our expectation of around $4,561 million. The profitability at 5,950 is a little lower than we were expecting at 6,150, but the range was very wide, right from 5,800 to 6,300 odd crores. So this falls towards the lower end of the range, so a bit of a miss on the profitability. The biggest headline, as I said, was the guidance cut sharply to 1 to 3.5%, and this is despite that the TCV in this quarter is quite steady. The TCV is actually $2.3 billion, which is actually an improvement of 10% on a quarter-on-quarter basis and 35% higher on a YOY basis, because last quarter this number was close to around 2.1%. The net hiring is also down. The net hiring is down by almost 7,000 people, so that's another big headline coming for you. But overall for Infosys, we have already seen a bit of a reaction coming in the global markets, where in the initial tick on the Infosys global listed ADR was a cut of around 3.5%, but this wouldn't go down well. I'm guessing there will be a slew of downgrades that will come in further after the kind of downgrades that we had seen in Q4, because large part of the street was penciling in a growth of 5 to 6% or at least 3 to 5% for Infosys. That now needs to be scaled down, and those are the kind of downgrades that we're expecting later.
We also see some impact in high-tech industry and in parts of retail. Even as we won 2 mega deals recently, we have a strong pipeline of large and mega deals. We see revenue from some of these and other large deals towards the later part of a financial year. Keeping that in mind, we are changing our revenue growth guidance for this financial year to growth of between 1% to 3.5% in constant currency.
The pricing environment, I think, remains quite stable. We have seen in some places we are able to get some increases from cola, etc. Some cases isolated, again, you get some discounts. But by and large, it's a very stable environment.
Still have a target for recruiting for the year, but we will see how that plays out with respect to what are the changes in terms of the demand environment and what we do in terms of the attrition numbers that we're seeing. The attrition that we saw in the quarter was stable versus last quarter. Our trailing last 12-month attrition is down to around 17%. So we see that driving some of the decisions on the recruitment.
Well, moving on from IT to FMCG. For FMCG major Hindustan Unilever HUL, rural recovery was slower than expected as volume growth managed to miss the street's expectations. Now, the net income too declined 3% sequentially, missing the estimates. My colleague Vinny Motiwala is here with the full analysis. Take it away, Vinny.
So when you look at HUL's numbers, first cut seems like a bit of a miss that has come in on the profit front, as well as slight bit of a miss on the margin front. Revenue that has come in line with expectations. So revenues seeing a growth of around 6%, while the margins of the company have come in at 23.2%, around 23.3% as well. Now let's move on and talk about the volume growth of the company. We were expecting around 5%. That has come in at around 3% for the company. The volume growth, underlying volume growth is what we're talking about. So that has come in at 3% for the company. Now, overall, when you look at it, home care business, that's seen a growth of around 10% as well. And the FMCG business, what the management is highlighting will continue see rebalancing, pricing, volume growth equation will gradually start improving. Consumer demand will gradually start improving as well. Beauty personal care segment, that's seen a growth of 4% as well. And mid-single digit volume growth is what beauty and personal care segment has seen. Now, other than that, when you look at it in terms of commentary, they said that rural growth has started turning positive for the FMCG industry. What they're saying is more than 75% of the portfolio has actually gained market share, and growth was competitive in this 75% winning market share as well. So let's keep an eye out on that. They said the margins have improved in all the three segments. That has remained healthy as well. Near-term operating environment, maybe a slight bit of a blip and volatility is what we could see coming in there, but consumer habits are typically seeing a bit of a recovery there, and pricing growth will automatically start tailing off, and we'll see more of a volume-led growth as well. They expect to sustain the volume momentum going forward as well. So let's keep an eye out on that. And obviously, as of now, commentary seems strong for the future, but HUL's Q1 numbers this time, slight bit of a miss.
Our margin, as I mentioned, is squarely focused on the line of gross margin this point in time. We want that to go up. And of course, what comes in EBITDA ultimately get driven by amount of money that we need to spend in AMP. So that will be more of an outcome this point in time.
The business is in a great shape. It's a great business. Very, very strong positions when it comes to market leadership positions of our brands. I see very strong, to your point of process, very, very rigorous processes. Our talent, depth and quality is absolutely first class. We have also done amazing amount of work on community. So I think we're living our vision and purpose of what's good for India is good for Hindustan Unilever.
Let's keep it with earnings then, and big boy Reliance is set to report its Q1 results today. Now the revenue is seen down 8% and PAT is seen down 15% on a consolidated quarter-on-quarter basis. So how has the company actually performed, and what is the street expecting? Somi joins in with all the number crunching and all the things that the street is watching out for.
Well, from Reliance Industries, it is expected to be a muted set of numbers in the first quarter of FY24. Now, if you see the revenues of the company, they're expected to decline by around 8% The EBITDA is expected to be lower by around nearly 1%, while the net profit is expected to fall nearly 15% on a sequential basis. Now, the fall in net profit is higher because in the fourth quarter of FY24, that is the FY23, that is the base quarter, the tax expenses were lower, and hence we are seeing a sharper fall when it comes to the net profit number. Now, segment-wise, if you see the retail segment revenues are expected to be 4% higher, but EBITDA number is expected to be higher by around 2.5% for the retail segment. Now, the reason behind this lower retail segment EBITDA growth is the fact that the fashion segment, that is the high margin segment, is expected to be weak in the first quarter of FY24. When it comes to the O2C segment, we are going to see a disappointment on that front, and that is the main reason why on a consolidated basis, the Reliance Industries numbers are sequentially lower. Now, OTC segment EBITDA is expected to be 4% lower on account of sequentially lower margins, and also given the fact that there was a shutdown in the Gujarat port because of the cyclone, and hence the sales volume also coming in, or the export volume coming in for Reliance Industries are also expected to be on the lower side. When it comes to the oil and gas exploration business, the EBITDA is expected to be 4% higher sequentially, and this will be purely on the back of a higher sales volume in the first quarter of FY24. To sum it up, O2C segment is expected to be a disappointment, while the exploration and retail segment growth is expected to be around 4% in the first quarter of FY24.
Well, those were the expectations for RIL, but Somit, stay with us. Jio is also going to report its Q2 numbers. What is the expectation on that front?
When it comes to Reliance Jio, if you see the revenue and EBITDA, they are expected to be higher by around 3%. Margins are expected to come in at close to 52.5%, while the net profit number is expected to be 2% higher. Now, ARPU, which is the key number for for the telecom operator, that is expected to be higher by around 1% to around 180.7 rupees per user per month. While the subscriber number, we are seeing a good growth on that front, at least from 43.9. That number is expected to come in at close to 44.7. And do remember, this is the 5th consecutive quarter where Reliance Jio has been able to add subscribers on its network. Now, subscriber growth is the main reason behind the growth in the financials of Reliance Jio in the first quarter. The 3% growth that we are seeing on revenue and EBITDA front is purely on the back of higher subscriber base. Along with this, rising contribution coming in from the home broadband business and a higher number of days on a sequential basis is also the reason behind the growth in the financials for Reliance Jio. Now, apart from the numbers of Reliance Industries and Reliance Jio, the key things to watch out for from the earnings would be any update coming in from Reliance Industries on the fact of tariff hike going ahead. What is the sales number of Jio Bharat phone that they have recently launched, and how is the traction that they're seeing on the home broadband business would be important to track. Also, any news flow on the Jio Financial demerger and any roadmap on the new energy business would be keenly watched out for from Reliance Industries earnings.
Thanks, Omid, for all those details. Let's keep it with the earnings expected today then. And cement major UltraTech Cement will also be reporting its Q1 results today. Let's go across to my colleague Mansi Dave, who tracks this sector, to understand what the street is expecting from the results.
Cement major UltraTech Cement will post its Q1 FY24 results, and this time we expect the sales to see an up move. However, the anticipation and the estimates on the profit front are of mixed numbers. If we have a look at the realization and the volumes, we expect the sales volume to increase around 20% on a year-on-year basis, aided by a good capacity expansion. At the same time, the realizations might be weak, and owing to weaker realizations, the EBITDA might see an impact. At the same time, if you have a look at the cost structure and the ready-mix concrete revenue, the RMC revenue is expected to see a rise of around 21% on a year-on-year basis, and the white cement revenue will see a rise of around 13% on a year-on-year basis. Coming to the cost structure, the operating cost per ton is expected to decline around 2% on a year-on-year basis, which is a positive. However, the variable cost per ton is expected to see a rise of around 2% on a year-on-year basis. There are a few things which we need to consider while we evaluate the UltraTech Cement numbers this time, and the first and foremost thing is the decline in the energy cost, which is likely, and at the same time the cement pricing trend, which has seen a weakness on a Q-on-Q basis. Coming to the capacity expansion, in Q1 FY24, UltraTech Cement commissioned 3 million ton per annum of grinding capacity, taking the total grey cement capacity in India to 129.95 million ton per annum. So all in all, the cement major UltraTech Cement might see an up move in the revenues front. However, the profits might see a decline or a dip for that matter.
And well, staying with the earnings, JSW Steel is also set to report its Q1 earnings, where the street is expecting a sequentially muted quarter. Now, Shesha is here with all the expectations.
Well, yes, for JSW Steel this time, we are expecting sequentially weak set of numbers due to lower steel prices and high cost coking coal inventory that the company has been sitting on. On a consolidated basis, revenues are expected to decline by about 6% on a sequential basis, while margins could come in at about 13.4%, indicating a contraction of about 350 basis points on a sequential basis. As I mentioned, lower commodity prices are expected to impact realizations this quarter. Remember, steel prices declined nearly 22% this quarter on a sequential basis, and hence realizations are expected to be on the lower side. As far as spreads are concerned, EBITDA per ton is expected to see a decline of a solid 30% on a quarter-on-quarter basis due to lower commodity prices and high cost coking coal that the company is sitting on. All in all, macroeconomic challenges are expected to impact JSW Steel's numbers this time. In terms of commentary to watch out for, management commentary on guidance for the full year and commentary on demand outlook will be keenly awaited.
All right, thanks Shesha for all those details, but stay with us then, because Vedanta is also set to report its Q1 earnings today. What is the street expecting? What are analysts penciling in? Take us through all of that.
Well, yes, prices of all non-ferrous metals fell during the quarter on a sequential basis, and that is going to impact Vedanta's numbers this time. On a consolidated basis, prices, revenues are expected to decline by as much as 18% on a quarter-on-quarter basis. Margins, meanwhile, could come in at 21.4%, indicating a contraction of nearly 350 basis points on a quarter-on-quarter basis. As I mentioned, decline in commodity prices is expected to impact numbers. Aluminium, zinc, lead, copper, crude prices declined anywhere between 5 to 8% on a sequential basis. As far as other internals are concerned, aluminium EBITDA is expected to decline by about 8% on a quarter-on-quarter basis due to fall in aluminium prices during the quarter. Zinc EBITDA, meanwhile, is expected to decline by 25%. Oil segment performance is also expected to be impacted due to likely discounts that were offered to clients. Management commentary this time from Vedanta will be very crucial. Commentary on capex for their semiconductor foray, commentary on parent Vedanta Resources liabilities, and commentary on steel segment divestment will also be keenly awaited. But all in all, weak set of numbers are expected from Vedanta. Revenues are expected to decline by about 18%.
Well, that was a roundup of all the companies that will be reporting their quarter numbers and what the street is really penciling in. But before we slip it.
Hi there, welcome back. Thanks for staying tuned to Market Cafe. We also have Ansh who's joining us in the studio today, and he's going to be taking you through a list of all the stocks that you should be keeping on your radar this morning. Take it away, Ansh.
Sure. So Jindal Stainless will be the first stock in focus for today's trading session, as they have completed the acquisition of Jindal United Steel for 958 crore. Earlier they were holding around 26%, now they hold 100% of the company. IndusInd Bank will also be in focus, as bank will be raising 20,000 crore through debt placement. On the earnings front, Persistent has reported revenue of 2,321 crore, which is up by 3% on a quarter-on-quarter basis, but due to increase in expenses by around 6%, PAT has fell by around 9%. Dalmia Bharat has reported revenue of 3,624 crore, which is up by 9.8%, but similar to Persistent, due to increase in expenses by around 11%, net profit has dropped by 33%. India Mart's revenue is up by 4.9% on quarter-on-quarter basis, and PAT has gave a jump of almost 49%. Union Bank's NII is up by 16.6%, and PAT has more than doubled. Mphasis revenue is down by 3%, and PAT has also fallen by around 2.2%. However, the order win in this quarter is more than twice of the average of the 4 quarters. So there is some relief in the results as well. Lastly, ICICI Securities revenue is up by 18% on year-on-year basis. The institutional equity revenue is up by 13%. Their total AUM grew by 25%. However, PAT fell by 1%. So this was mainly due to spike in interest by around 85%, from 100 crore to 185 crores.
All right, then thank you so much for that, Ansh. But Dalal Street gears up for yet another listing on the bourses today, and that is Utkarsh Small Finance Bank. Let's look at the details of the IPO now. If you look at the company, the bank was incorporated in 2016. It is the second fastest growing bank in the small finance bank space between FY19 to FY22. Now, the bank is primarily focused in the rural and semi-urban areas and the MFI space. Now, it is present in 26 states, and it has 830 banking outlets with 15,000 employees, 36 lakhs customers, and 27% of the bank outlets are in the unbanked rural centers. So it primarily focuses on the rural areas of the country. Now let's look at the IPO details. The IPO's price band has been 23 to 25 rupees per share. The issue size is for 500 crores, and the total issue size is 200 crore shares. Now, if you look at the IPO proceeds, the objectives of the IPO was basically the augmenting of Tier 1 capital base for the bank, and that's why the money is being raised. Now, the post-market cap of the issue, once the company lists on the bourses, it is going to be between 2,500 to 2,700 crores. Now, let's look at the company and the strengths and the strategies for the company. Now, it has a strong rural presence. It has a joint liability group lending for income generators. It has a strong relationship with the borrowers, and it has its primary focus on retail deposits to build stable funding resources. Now, it also is been diversifying towards retail. It has significant cross-sell opportunities, stable growth, and cost-efficient operational performance. So these are the strengths for the company. And if you look at the geographical mix, is primarily focused in Bihar, with the 31% in Bihar and 26% in UP. Now, let's look at the financials of the company. The loan book for the company has grown to 13,000 crores in FY23 versus 8,000 in FY21. The ROA is at 2%, 2.4% in FY23 versus 1% in FY21. The CASA has also increased to 20% versus 17% in FY21. And if you look at the kind of listing that post the listing, the shareholding that the promoters will have, that will be reduced to 69% post the listing for the promoters, and the public will thereafter hold 31% of the total shares for the company. So that is the company that will be listing on the bourses as of today, Snehi.
Absolutely, Ankita. New listing on Dalal Street today. Keep an eye out on this one. But moving on then, United Spirits posted a good set of numbers in Q1 with a significant margin improvement on a quarter-on-quarter basis. Ashesha is here to do all the number crunching and analyze those numbers for us. Ashesha?
Well, yes, United Spirits reported a very strong set of numbers, and it has reported margin expansion across the board, both on a quarter-on-quarter basis as well as on a year-on-year basis. Remember, the company has been focusing on premiumization, and that has probably resulted yields. P&A segment has seen a growth of about 21.4% on a year-on-year basis in value terms. As far as the management commentary is concerned, that continues to be a little muted. They've been talking about inflation for the last many quarters, and they say that inflationary concerns are likely to persist for some more time. As far as numbers are concerned, consolidated revenue saw an uptick of about 7% on a sequential basis. Margins, as I mentioned, they've come in at 26.4% in the quarter gone by versus margins of just 9% that the company had reported in the previous quarter and 15% that the company reported same time last year. P&A segment, that has grown about 21.2% on a year-on-year basis. Remember, this segment contributes 86% of the company's revenue, and the company has been focusing on premiumization, and hence this segment has seen significant growth. Management commentary, as I mentioned, inflationary trends are expected to persist for some more time. They say strategy to reshape their portfolio with revenue growth management is what is driving P&A growth. All in all, very strong set of numbers have come in from United Spirits with significant margin expansion this quarter.
All right, Ashesha, thank you so much for that. But some more quarter earnings and some more previews there. We have a Paytm first up. Now, Paytm is set to report its Q1 FY24 numbers, and let's look at what the street is penciling in. We'll look at the number of loans that is likely to come in at 1,28,000, likely to be up 10% on a sequential basis. We also have the value of loan growth that is expected to go up to 26% on quarter-on-quarter basis. The GMV is likely to come up at 4 lakh crores, up 15% on a sequential basis, and the devices employed is also likely to go up to 16%. And the monthly user base is also likely to see an uptick of 3.4% on a quarter-on-quarter basis. Now, if you look at Motilal Oswal, what are they expecting? They're expecting the revenue from operations, to come in at 2,400 crores versus 2,300 crores in the previous quarter. They also expect the contribution of PAT at 1,300 crores versus 1,280 crores in the previous quarter, and they also see an EBITDA. They do see an EBITDA decline though of 100 crores versus 230 crores in the last quarter, and a loss coming in at 300 crores versus 170 crores in the previous quarter. So that's the roundup of what the street is penciling in for Paytm.
All right, and L&T will also be in focus as it is set to consider a buyback and special dividend when it reports its earnings on the 25th of July. JM Financial expects this to help the company reach its ROE target. My colleague Lisa joins in with more details on this. Lisa?
Right, so L&T will be considering buyback as well as special dividend, and this will be on 25th July when they will be announcing their Q1 result as well. Now, according to GM Financial, they expect that the buyback amount that will be around 10,000 crore, and this is after considering the cash position in their standalone balance sheet, which stands at around 25,000 crore, and their net cash position that stands at around 6,600 crore. Now, do note that way back in 2019 too, L&T had attempted a buyback of around 9,000 crore, but that couldn't go through because that time the threshold limit of their debt equity ratio that exceeded the threshold limit, so they couldn't go through the buyback. But now in Feb 2023, SEBI had amended the norms, and according to the amended norms, the maximum limit for tender that can be determined through standalone basis also, which can be around 25% of the paid up capital as well as free reserves. So considering that, the maximum limit that stands at around 17,900 crore. And L&T had also set a target, a strategic target of reaching 18% ROE. Now the ROE stands at around 11.6%, but they are considering that that the distribution to existing shareholders through buyback as well as dividend, that will help them reach their ROE target. And GM Financial expects that the stock will react positively to this news of buyback.
All right, thank you so much for that, Lisa. But we have Vamakshi joining us with all the brokerage notes that have come in this morning. Vamakshi, take us through what the brokerages are saying.
Well, yes, all eyes will be on HUL as well as Infosys. Both these big companies have reported their numbers, and we have a few brokerage notes coming on the same. Let's first start off with HUL. We have a note coming in from Jefferies, and they have highlighted that the company has reported a weak print as far as volume growth is concerned. In fact, just volume growth came in at 3% on a year-on-year basis, which is at a 5-quarter low. The outlook also that came in from the company was quite cautious, as a recovery is expected to take time due to macro headwinds. So overall, Jefferies has gone ahead and cut its EPS estimates by around 1 to 3%, and in fact downgraded their rating as well from buy to hold, and cut their target price to 2,770 per share. Other than that, we'll be keeping an eye out on Infosys. We have a note coming in from Nomura. They have highlighted that the weakness in growth is magnifying. The company has announced a significant guidance cut. They also believe that the company is set to underperform the industry growth in FY24, which is why they've gone ahead, downgraded their rating to reduce from neutral, and also trim their target price to 1,210 per share. On the other hand, we also have Jefferies, who's maintaining a buy on Infosys, given a target price of 1,550 rather. They have lowered their estimates by 2%, but they also see limited risk of further earnings cut, and with that they also see reasonable valuations as far as Infosys is concerned, and they also have highlighted that they would be buyers in Infosys after the fall. So largely those were all the important brokerages that you should watch out for in the trading session today.
All right, thanks for that quick roundup, Vamakshi. But with that, we're completely out of time on this edition of Market Cafe. Wishing you a very happy weekend. It's a goodbye from me and Ankita.
When timeless European